Have you ever placed a trade that seemed perfect until the market flipped in an instant and left you watching your account balance drop like a rock? If so, you're not alone. Most traders face that sinking feeling at some point. The difference between those who recover and those who burn out is effective risk management. In this video, we'll break down the key elements of risk management and then dig deeper, showing you exactly how to use these tools to safeguard your capital, boost consistency, and build long-term success. Stick around because understanding these concepts can truly transform your trading journey. Risk management isn't just about using stop losses or limiting how much money you put into a single trade, though that's part of it. It's a holistic framework that guides every decision you make, from what markets you trade, to how much of your capital you allocate, to when you exit positions. Think of it this way. You wouldn't drive a car at top speed without brakes, seatbelts, or airbags. Similarly, trading without risk management is like racing down a financial highway with no safety measures in place. So what are the core constituents of a solid risk management strategy? Let's break them down into 5 key areas. 1. Position sizing, determining how much capital you allocate to each trade. 2. Stop-loss placement, setting predefined exit points to limit losses. 3. Risk-reward ratios, balancing potential losses against potential gains. 4. Diversification and correlation management, spreading your bets across different assets and strategies. 5. Emotional discipline and rules enforcement, sticking to your plan, even when it's tempting to deviate. These 5 pillars work together like a well-oiled machine. Each part reinforces the others, ensuring you stay in control, even when markets throw you a curveball. Position sizing is where it all starts. Without a clear method to determine how much capital you put into a trade, you risk putting too many eggs in one basket. For example, let's say you have a $10,000 account. One trader might throw the entire $10,000 into a single stock trade because they're confident about it. Another trader, with proper risk management, might decide to risk only 1% of their capital, $100, in that trade. If the trade goes wrong, the first trader could face a catastrophic loss, while the second trader limits their downside and lives to trade another day. By committing to position sizes that reflect your risk tolerance, you ensure no single loss can knock you out of the game. Over time, this stability compounds, allowing you to steadily grow your account rather than risking it all on one roll of the dice. Next up, the stop loss. This is the safety net that prevents a losing trade from becoming a financial black hole. Placing a stop loss is like drawing a line in the sand and saying, if the market goes beyond this point, I'm out. For instance, if you buy a stock at $50, you might set your stop loss at $48, risking $2 per share. If the stock dips below $48, you exit immediately. This small, controlled loss is far easier to recover from than a trade that plummets unchecked to $40, $30, or even lower. Some traders resist stop losses, hoping a losing position will bounce back. But hope isn't a strategy. Setting a stop and sticking to it ensures you never let a small loss turn into a disaster. Trust me. One of the hardest lessons in trading is learning to accept a loss and move on quickly. Let's talk about risk-reward ratios. This ratio compares what you stand to lose if the trade goes wrong, your risk, with what you stand to gain if it goes right, your potential reward. A common guideline is a 1-to-2 ratio. Risk $1 to make $2. Why does this matter? Consider a scenario. If you risk $100 per trade and aim to make $200 when you're correct, you don't need to be right most of the time to make money. Even a 40% win rate can be profitable. This mathematical edge gives you breathing room. You don't have to nail every trade. By consistently maintaining a favorable risk-reward ratio, you create a structural advantage in your trading approach. It's like running a business where, even if some products fail, the profit margins on your winners more than cover the losers. That's what keeps you afloat and growing over the long term. Diversification is a classic principle for a reason. If all your trades are in the same sector, say, tech stocks, then one piece of bad industry news can sink your entire portfolio. But if you spread your capital across technology, healthcare, consumer goods, and maybe some foreign equities or commodities, a downturn in one area won't cripple your account. Correlations matter too. You might think you're diversified by holding multiple assets, but if they all move together, such as certain currency pairs or markets that respond similarly to macroeconomic events, you're not truly protected. Imagine you're trading futures on oil, natural gas, and energy sector ETFs. If the whole energy complex tanks, everything drops together. True diversification means holding positions that don't all react the same way to the same triggers. All these tools, position sizing, stop losses, Risk-reward ratios, diversification mean nothing if you don't have the emotional discipline to follow them. It's all too easy to ignore your rules when you're caught up in the excitement of a winning streak or the panic of a losing trade. But that's the trap. Your emotions will try to convince you that this time is different. Guess what? It rarely is. Successful traders stick to their rules. They treat trading as a business, not a casino. If you've decided you'll risk only 1% per trade, that's what you do. No exceptions. If your stop loss gets hit, you accept the loss and move on. If you've hit your daily loss limit, you stop trading for the day. By enforcing these boundaries, you shield yourself from impulsive decisions that erode your account and confidence. Let's say you're an intraday trader who likes to capture short-term moves. You start your day knowing you'll risk no more than 2% of your total capital. If you have a $10,000 account, that's $200. For each trade, you use a stop loss that limits you to a $50 loss. That means you can try up to 4 trades before hitting your daily loss limit. If the first trade loses $50, you move on to the next. If your second and third trades each net $100 profits, you're already up on the day. And if you hit your daily risk limit, you stop trading and preserve what's left for tomorrow. This approach ensures longevity. Over time, even if some days are losses, your account will avoid catastrophic drawdowns. Steady gains combined with strict risk protocols build a stable equity curve rather than wild swings. Now, if you're still skeptical about the importance of risk management, consider the alternative. Without it, you're one big trade away from blowing up your entire account. All the analysis and predictions in the world can't guarantee profits if you let your losses run free. Markets are unpredictable, and no trader, no matter how experienced, can avoid losses entirely. The only control you have is over how much you lose when you're wrong. Imagine the feeling of slowly, steadily building your capital, knowing you're protected against any single catastrophic event. That's peace of mind you can't put a price on. By embracing risk management, you're not just protecting your money, you're protecting your future as a trader. Ready to put this into practice? Start by defining your risk tolerance. Decide on a maximum percentage of your account you're willing to lose in a single trade or day. Next, map out your stop losses and calculate your position sizes based on those risk parameters. Test your strategy on historical data. Does it hold up under volatile conditions? If you're unsure where to begin, start small. Risk less, trade smaller positions, and get comfortable following your rules. Gradually scale up as you gain confidence and consistency. Over time, good risk management practices will become second nature. Risk management might not be the most glamorous part of trading. It doesn't promise quick riches or excitement, but it's the bedrock of long-term success. By carefully controlling how much you risk, setting strategic stop losses, maintaining favorable risk-reward ratios, diversifying your bets, and enforcing your rules with iron discipline, you create a trading environment where you don't just survive market turbulence, you thrive in it. If you found this video helpful, don't forget to like and subscribe. Also, share it with fellow traders who need a reality check on risk. Let's foster a community of well-prepared, disciplined traders who understand that the key to winning isn't just making money. It's knowing how to protect it. Thanks for watching, and I'll see you in the next one.